My name is Elfreda. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Chris Willcocks with me. He's one of our global portfolio managers and he's also the analyst on the industrial sector that we will be discussing today. So Chris, welcome.
Thank you.
And as a starting point, the second quarter global reporting season is well advanced. We're at the point where we can pick up a number of key themes playing through the market. Can you tell us what are some of your key takeaways at this point?
Sure. Look, I think the key message from the second quarter reporting season was just how strong it was. Almost by any measure you look at, that was a very, very good reporting season. There's still a few companies yet to report, but as a general rule, it was very strong. To put some numbers around that, nearly 80% of companies beat earnings expectations in the quarter versus what we would normally expect to see around 2/3. Revenues will have grown at 15% once the reporting season's done, which is the fastest growth rate since the sort of post-COVID recovery reopening quarter. It's not just tech.
Yes.
11 sectors, all 11 sectors are reporting growth. 8 sectors are reporting double-digit growth.
Yes.
And once you sort of aggregate all the earnings up, earnings will have grown for the S&P as an example, about 50% year over year, which compares to expectations of around 20% heading in. Now, not all of that growth is real. It is flattered by mega cap tech stocks, which reported mark-to-market gains on their private investments like Anthropic. But even if you back that out, earnings growth for the S&P 500 will be about 28% year over year. So it's exceptionally strong. Possibly the only negative data point that I saw was that the median stock price move on day of results was a measly -4 basis points.
Yes.
But otherwise, it was a very, very strong second quarter for companies globally.
So really strong numbers, but not a lot of conviction to trade them. And equally quite strong across Europe, Japan, and some of the other key regions as well. So let's pivot to one of the sectors that you cover, but industrials. It's also had a really strong reporting season. Tell us, what do you think are some of the key themes driving that sector specifically at the moment?
Yeah, I mean, industrials was broadly reflective of the market overall. Reporting season was very good. Companies beat generally on the top line and the bottom line. But two themes that sort of emerged over the course of reporting season. Any company in that AI, CapEx, hyperscaler data center, supply chain reported very well.
Yes.
Expectations were very high for these companies, but even those expectations were eclipsed, particularly when it comes to orders. So to put a case in point, Caterpillar, it's a portfolio stock, they reported 60% order growth year over year.
Yeah.
Siemens Energy, another portfolio stock, they make gas turbines, they reported 60% order growth year over year. These are massive billion-dollar revenue businesses reporting huge growth numbers in orders. So that was generally expected to be positive and, was and more so. What we also saw was increasing evidence of broadening out beyond those companies servicing or building data centers.
Yes.
So transport companies, they're reporting better volumes, better price. Mining companies and mining equipment companies performing very well. You're starting to see construction and infrastructure companies return to growth. One of the companies that we own, Parker Hannifin, it's an industrial conglomerate. They make things like actuators, valves, pumps.
Yeah.
They reported 16% order growth in their North American business and 24% in their international business.
Okay.
So these are growth numbers that we haven't seen since COVID. So you are seeing that broadening out beyond just data center related industrial companies, and it's probably reflective of a more broadening in the industrial economy.
Fantastic. That is really good news overall, I guess, for not just the US market, but across the board. So at this point in time, you have added a number of new stocks to the portfolio. Can you give us one example and why did you buy that stock specifically?
Yeah, I mean, a stock that we added recently, I alluded to transport starting to perform a little bit better. Industry commentators have referred to the last 3 to 4 years in transport markets in North America in particular as the freight recession, as the worst recession in freight markets since the GFC. That's been driven by post-COVID hangover, oversupply of truck drivers, general industrial stagnation in the US. And it looks like we're past the worst. So you're starting to see freight rates pick up quite materially over the last 6 months. That's being driven by regulatory changes on the truck driver side. Truck drivers are leading the industry. That is spilling over into better pricing in rail markets, and the stock that we've added recently is CSX.
Okay.
So CSX is a Class 1 North American railway operator. They service generally the sort of East Coast, Eastern Seaboard, and you've had this period where margins have contracted and we're starting to see that change again. So you're starting to see volumes come through for a while now and pricing's starting to pick up. On top of that, CSX has a new CEO, a CEO we're quite familiar with and is very highly regarded in the US markets. He's very focused on improving service levels and efficiencies in the rail network. That's showing up in better margins, and now they're starting to take share. So that's a stock that we think can compound earnings in the mid-teens for the next few years, and in the low 20s for a PE multiple we think is attractively priced.
And a really good diversifier to the rest of what we have in the global portfolios.
For sure, yeah.
Thank you, Chris, and thank you for listening. For more information from Chris and the team, please visit us on alphinity.com.au. Thank you.
Thank you.